Good evening, ladies and gents, and welcome back to another video. It's a heavily requested one today, and it's all about Fibonacci. Now, the bulk of this video will cover everything you need to know about Fibonacci. I've taken part of the technical side of this video from my Anomaly Mastery course, where I have a couple of videos on Fibonacci, but I've taken the biggest one from that module and popped it in this video so you guys can get an insight into the course, an insight into Fibonacci in a really good depth with good clarity, good explanation, so you can immediately start implementing it into your trading. So stick around to the end for this one because I think you'll find it incredibly insightful, and it'll give you an insight as well in terms of into my style of education and how I maybe have helped you in terms of helping you get to that success in trading. So enjoy, and I'll catch you towards the end of the video. Fib levels are much more likely and respected on higher time frames, so the weekly, the daily, the 4 hour in particular. They're one of my major conferences. They're not enough of a conference on their own to take a trade off. You have to use these Fibonacci levels in conjunction with obviously multiple other conferences, as you know, and as they are covered in this course. But they are a big conference, especially when you're using them on higher time frames. Fib levels do work on lower time frames, don't get me wrong, but obviously when you're trading off lower time frames, those fib levels are less likely to be respected because actually the lower time frames don't give the overall picture of the market, whereas the higher time frames do. So obviously I don't really trade a lot of lower time frames, 1 hour, 30 minute and below, but they do still work on lower time frames as long as you're trading with the trend and things like that and you're not getting caught out. So guys, let's get cracking into the Fibs module. There's a lot to cover in it and I think you'll find it incredibly useful, and if you aren't using it already, I think it'll be a tool you start using from when you've sort of finished watching this video. So guys, I want to use as many real life practical examples in this course because then it helps you visualize a lot easier and it helps with me talking over at the same time, so you can apply and transfer these principles over to your own charts, over to your own trading as soon as possible, so you can literally start changing up your trading for the better immediately, really. So let's just take US dollar, okay? Obviously, it's a huge, the US dollar index tells us so much about markets, which obviously I'll cover in another module in this course. So typically here, again, I'm not going to go into too much detail on other bits and pieces because that is covered in other modules. So we'll try and keep it strictly about fibs, but it is hard not to talk about other stuff because we talk about things as conferences together to paint a bigger picture. But anyway, so US dollar, we broke into the downside on the daily, bearish structure. The leg has finished because we formed a base here. The daily started to push up. So we get our fib tool. We fib from, because it's a bearish play, we fib from the most recent high of that bearish leg to the most recent low. And it is wick to wick, not body to body. People think it's body to body. It is not. It is wick to wick, I can assure you. Because the wick obviously shows where price has been, but obviously failed to close at. So, for me, I very rarely use the 38.2. But guys, just pause the video now if you want to. These ticked levels here are the levels I will only use. So you've got this, the 0 and the 1 just shows you from the low to the high or the high to low. So obviously you've got those in there. 0.382, 0.5, 0.618, 0.786. And then your fib extension targets, where your profit levels are, which we'll come on to, is minus 0.27 and minus 0.618. Take a screenshot now or pause the video and put these levels into your fib retracement tool and save it as your default, okay? These are, I promise, the only levels you need. Now, just a word of, not caution to that, but a word of advice. The 38.2% here is only really respected on, I find price typically comes up higher, than the 38.2%. It comes into the majority of time, the 50%, the 61.8 or the 78.6, okay? You'll see it only come into the 38.2% when you've had a huge move to the upside or the downside. So let's say, this is a decent, fairly big move, but let's say that move had come down a lot further and we fibbed that new leg. Sometimes after such big moves to the upside or the downside, when price retraces, because it's so heavily in one direction. When price does retrace against that, it only does a shallow retracement, and sometimes only it will go up to the 38.2. So I always like to get that comment out there, because when you've seen a huge move, some people think it's going to come all the way back up to the 50, 61.8% or the 786, and very rarely will it on very big market moves. It will sometimes only come up to the 38.2% before it then travels off in the intended direction again. So just one to make a note of, guys. But anyway, back to this example. So, daily bearish leg, we fibbed it. Okay, with our normal fib levels. I'm going to take the 38.2 off for this example, okay, so there's not too much noise on the charts. We then expect price to come up to either here, here, or here. Now, when we look at this now, look at the fib in conjunction with other variables. We've broken this structure here to the downside. So the 61.8 might be a potential region where that prior structure is. But we've also got this wicking here, and this prior piece of main structure as well. So for me already, before this has come back up, we are looking, if you just get the box, I am looking already between some form of the 61.8 or the 50% as an area of interest. Now typically, I would call this our golden fib level, golden fib pocket, golden ratio, whatever you want to call it, doesn't matter too much. Because typically these two fib levels is where price will come up to in respect the majority of the time. Majority, not all the time, but the majority. Okay, so if we just slow this down though so we can talk this through. Let this play out now. So we're expecting a pullback, which we get. Right, we get one wick into the 50% and retracement. Okay, we get a second daily push into there with a wick and a current potential retracement. Now let's just see what price does around the 61.8. So as you can see, and we'll pause it there. As you can see, price has not respected the 50%. Price has not respected the 61.8 because it is technically body, let's get the box out of the way now, because it's technically body closed above it. So at this point in time, when we see this price here, we're now thinking, right, well, it's not respecting the 61.8, so two things are going to happen. We're going to have some form of reaction in this area here, or it's going to tap into the 78.6 before then retracing. And what do we end up happening? We had a push up, we had a wick up, and then a spinning top, which is, again, I'll come on to in candlestick formation, different module, but that obviously tells us that as a sign of a potential reversal. You could call that spinning top, you could call that a doji, both are signs of reversals. And then we start to then see what happened next, followed by a daily bearish candle, and then boom. Okay, so sometimes it doesn't matter too much as long as it works and you see signs of rejection, signs of reversals around that area of interest. So let's just take the 50% off again so we keep the chart as clean as possible. Look what's ended up happening. This prior piece of structure that we broke when we had this bearish leg, this prior piece of structure tends to get respected again, or tends to get retested, should I say. And that's what we've seen here. Look how cleanly that piece of structure is here to here. So we've had 1, 2, 3, and then sell off. So I'm going to give you lots of examples in this fib module, because obviously sometimes it'll come up to 78.6% and then melt, or sometimes it'll come up to 50%. So I'm going to give you, like I said, a few real life examples. But again, if we look at the 618 here, if we were to break down onto the 4 hour, what did we see on the 4 hour? This is why candlestick formation is huge. We just saw, look how many 4 hour candles. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. We saw 10 4 hour candles. That is a long, that's from Thursday the 9th of November to Monday, okay? Now obviously the weekend shut for 2 of those days, but there's a lot of 4 hour wicking. Look at wick, gradually slowing down and gradually retracing. And then boom, we got that 4 hour sell off there. we then got a retest, and then the actual big move. So your ideal entry here would have been, we had the consolidation, we had the ranging happen, so we think, right, well, that's enough 4-hour candles to show that price is stalling around this area of interest. Prior structure 6178.6 for example, those two fib levels we're stalling in between. There's enough price action there to show that we're slowing down and respecting, and not just bombing through it. And this is why, again, you can use fibs, because we've then had that 4-hour sell-off, the first bit of proper price action again, showing us some downside, because all of this is neither up or down, it's just trading sideways. So we then see this, so we fib that 4-hour small mini leg, like so. Let me just zoom in on here as much as possible, guys. I'm just going to delete that bigger fib, okay? So we fib that 4-hour leg. Get rid of these so we keep it as clean as we bloody can. We fib that 4-hour, and then for the best risk to reward possible, we await for a short temporary 4-hour pullback off the 50%, off the prior break of structure there on the 4-hour, and then boom, we have the sell-off. Okay, so guys, you can use fibs to then also look at more decisive entries, more pinpoint entries. Okay, because some people might think here, getting in here is a poor entry, because we're still consolidating. Well, sorry, should I say getting in around here is poor entry because there's not a huge amount of rejection yet. You want to be looking for some form of candlestick where it shows you a direction of price. Because like I said, all of this is just trading sideways. We wick down, we've closed up. We've wicked up, we've closed down. You know, again, so there's indecision here, which is a good sign around our area of interest, because it shows us that price is slowing, price isn't just pumping or wicking and then melting. And then when you see a more decisive candlestick like this, then we can look at fibbing that leg and then seeing the sell-off. So I'm going to give you a few examples, guys. So that's one example. Let's look at a bullish example. Okay, again, we're going off higher time frames still, because that is when fibs are most respected. So we have a daily breakout here. We've broken this prior higher, this lower high that was formed in this bearish downtrend. We've broken out, broken structure to the upside. So we will fib this most recent daily leg. Okay, let me just pop that on a slightly slower. We would await for just probably one more daily candle, which we should get. Yeah, so that is definitely a new leg. So we fib that completed daily leg. Now, we're already looking, if we pop on our main areas of interest again, okay, what we're looking for here now is obviously some form of pullback, probably a retest of this broken structure, before then obviously this forming its next leg to the upside. So if we just let this play out slowly, right, so again, let's pause it there. 50% not respected, but 61.8 perfectly wicked into, so price has travelled into there, body closed above, before then onto the next one. So this is why, guys, fibs alone are not enough to take a trade-off, but used in conjunction with other confluences, they absolutely are. So on this trade here, before price had obviously played out, you could very much argue it's going to come into the 50%, because it's around prior break of structure, it's around 102.50, around site number, and this is the thing, sometimes price will come into it, wick to the fib level below, and then push on. Now, if you think between the 50% and the 61.8% here, there's only a difference of what, 14 pips. So even if you were entering off the 50%, because that's where more of your confluences were, you would only be in a 14 pip drawdown before then it obviously pumped and went on 100 pips eventually to the fib extension. But this is why, again, you use them within other confluences and in conjunction. Because if we look at the 4-hour here, the 4-hour didn't actually respect the 50%. Look, we look at this 4-hour candle here around the 50% level. That to me says, right, we're coming lower. That to me does not say we're rejecting the 50%. So this is why you can't really just set buy or sell orders, because or buy orders in this case, because that price action is not nice at the 50%. That does not tell me, oh, price is slowing, price is rejecting. That tells me price is going to keep coming down. And what we then got, the following 4-hour candle, was a push down into that area of liquidity, area of interest, area of around the 61.8. We've wicked back up. So then once you've seen that 4-hour candle, we've wicked down but had a big sort of pullback and close above. Then you're immediately thinking, okay, that's much more respectful in nature compared to that candle. So then you start thinking, okay, 61.8 does look like it might be rejected. This candle fails to break below. This candle, again, a candle of indecision, followed by then that 4-hour candle closing above these prior 4 4-hour candles. And that does slightly close then above the 50% fib level. So then would be a good time to enter, hence then what we've then seen follow. So guys, this is why if you can try, when price does get into your area of interest and around your potential fib area of interest, it's then worth just looking, why is that blue box on there? It's then just worth you seeing what price is doing in and around those levels to see actually, is it respecting any of them or is it just going to melt through? But most likely at the time, if you've got the daily and the weekly in sync in terms of time frames, in terms of bias, so if the daily's both bullish and the weekly's both bullish, then most of the time you can be assured that price on the retracement will come down to one of those levels, respect one of those levels, and then continue on in the intended direction. So it's really, really important. Really important you try and not just set orders, and that you try and see where price is coming into and where it respects, so you can get a cleaner entry, a better risk to reward, a more probable likely outcome. Because as we know, sometimes if price wants to, price will just sink through and invalidate all of those. Okay. So ladies and gents, I hope you found that super helpful. If you have any questions, please reach out, because I appreciate we've covered an awful lot in today's video. I hope you found it really insightful. And if you have any questions, like I said, feel free to reach out. And if you're interested in going and taking my course as well, then the link's in the bio. Take care, guys, and I'll see you on the next one.